estate planning topic, estate taxes. A lot of my clients get confused over the federal estate tax system and how that works and what's going on, what are the current events in the estate tax system. So the best way that we found to communicate what is going on in the law is through a story, and we call it our IRS supermarket story. So bear with me through the story because I'm going to give you progression on where the estate taxes have been and where we're going to be going in the future. So in this story, this IRS supermarket story, geography is really critical. So let's pretend that everything over here, this is our supermarket, and everything in our supermarket is subject to estate tax or death tax. And let's say that in the supermarket you can have your investment accounts, your annuities, your life insurance, your real estate, all of these things that are subject to tax and everything in your own name. And let's say that we have a husband cart and a wife cart. And during your lifetime you're shopping and you're putting things into your cart. Imagine this is the checkout counter, also known as an IRS auditor. The IRS not only wants to tax you on your income all throughout your lifetime, when you pass away, they want to add everything up, and if you hit certain numbers, you might be subject to what's called an additional estate tax. And so I'm going to walk you through that as well. So that's our checkout counter, and then here is the parking lot. The goal is to get as many assets from inside the supermarket out to the parking lot. Parking lot is death tax free zone, okay? That's where we want to go. So if we're playing out this story, I'll use myself as an example. So let's say I'm shopping in the supermarket of life. I got my real estate, I got my investment accounts, my IRAs, and at some point I have to check out. And when I check out, I put everything onto the belt, and at that point the IRS is going to check, get a valuation, and we're going to find out what I passed away with at that time. Let's say for argument's sake that I passed away with $5 million. So if I pass away with $5 million, I have an option. And right now everyone has a coupon actually worth $5,120,000 for 2012. So let's say that I had $5,120,000 in my cart, and the IRS person is going to look at me and ask me what I want to do. My first option is I could say I want to use my coupon. So I take my coupon out of my pocket, they scan the coupon, we put the $5,120,000 into my cart, and I go out of the parking lot. In this scenario, did I pay any tax? Technically, I did not. I used my coupon, and right now everyone has a coupon worth $5,120,000. So that's scenario one. You can use your coupon and take that out of the IRS supermarket. Option number two is when I check out, when I pass away, I could say, I don't want to use my coupon. I'm going to leave everything to my spouse, and I'm going to go walk right out of the IRS supermarket. In this scenario, did I pay any tax? No, right? Did I get anything out of the supermarket? Zero. My pockets are empty out here. Everything is still inside of the supermarket. And so who do you think the IRS is looking for? They're looking for my spouse. And so this is a very important exception. It's called the unlimited marital deduction. I call it the Melinda Gates exception, in that even Bill Gates, one of the richest men in the world, can walk right out of the IRS supermarket and not pay one dime of tax. He could leave everything to his spouse, Melinda Gates. But you better know that the IRS is going to look for Melinda Gates when she checks out, and then there's going to be a tax hit at that point in time. And so the important thing to understand is that the estate tax is not due until the death of the surviving spouse. Actually 9 months from the date of death of the surviving spouse, if things are planned properly, normally. Okay? So under that scenario, let's say that I've left my assets to my wife, and let's say she's doing her own shopping, and when she checks out, let's say that when she checks out, her assets total $5 million in her cart as well. And so if she has $5,120,000 in her cart, she can use her coupon when she checks out. The issue will be that $5 million that I left on the belt to her, the $5,120,000 I left on the belt to her. What will happen to that money that I did not take out of the IRS supermarket in that scenario? So what happened under the old law was that money would be taxed at about 50%, and that would be due 9 months from the date of death of the surviving spouse. So there would be a $2.5 million tax due. And the scary thing is that all could have been avoided if I had used my coupon on my first death, at the first death. And so what I kind of jokingly tell my clients is the whole point of this IRS supermarket story is to get double coupons, double coupon days at the IRS supermarket. I pass away, I use my coupon IRS, $5,120,000. My wife passes away later, she uses her coupon. We've sheltered down $10,240,000 worth of assets under the current law. Okay, so how has the law developed and what are the ins and outs of that? You need to know a little bit about the federal estate tax system to understand this point. Okay, to understand the federal estate tax system and building on the IRS supermarket story, you need to understand how the coupon amount or applicable exemption amount has changed throughout the years. So right now, currently in 2013, we have a $5,120,000 coupon. How did we get there? You need to understand how we got there because where we're going is tied to that. So let me give you a little brief history of the federal estate tax. In 1980, during the Reagan era, the coupon was at $600,000 at that point in time. So you could pass away with up to $600,000 and you had that coupon amount that sheltered those assets. In 1997, the Taxpayer Relief Act was passed and Clinton was in office. And what that said is, we're going to keep a $600,000 coupon for now, but we're going to have gradual increases for inflation until in 2007, we're going to have $1 million as our coupon amount. Well, between 97 and 2007, Bush was elected. In 2001, we passed the EGTRA legislation, and that was in 2001. And what that legislation said was we didn't want to wait till 2007 to get our coupon or exemption amount raised to $1 million. We want to have that coupon amount raised to $1 million immediately in 2001. So in 2001, there was a $1 million coupon, and then there was gradual increases for inflation. In 2009, it got up to $3.5 million coupon, for those of you who can recall that. And then in 2010, under the EGTRA legislation, it mysteriously disappeared, the estate tax. And then in 2011, the coupon or the exemption amount or that legislation, that EGTRA legislation, had to sunset. And it was required to sunset by law. It was not a permanent legislation. And what it had to sunset to was the old Taxpayer Relief Act, which the Taxpayer Relief Act said we have a $1 million coupon. So if you're following me, in 2009 there was a $3.5 million coupon. In 2010 there was no estate tax. And then in 2011, by law, that legislation, that EGTRA legislation, had to sunset and go back to the old Taxpayer Relief Act and the $1 million coupon. Well, what Congress realized was in December of 2010, they passed legislation. Obama signed into law on December 17th, right before the legislation expired. They signed a law that said for the next 2 years, we're going to extend that coupon. We're going to raise that coupon for 2011 to $5 million, and we're going to have an index for inflation. In 2012, we're going to have that coupon up to $5,120,000. And then in 2013, guess what? We go back to the old Taxpayer Relief Act unless Congress acts. So that means in 2013, we're scheduled to go back to a $1 million coupon unless Congress acts again. So obviously, it depends on who gets elected in the November 2012 elections and what Congress does to determine what the coupon amount or the exemption amount will be in 2013. For sure, we know at least it will default to $1 million unless Congress acts. And so that gives you a little bit of a background on that. A couple other pieces of information that's really important that happened in that Trichka legislation that occurred at the end of December of 2010. So they changed the estate tax rate to a flat tax rate now of 35%, changing it from a graduated scale that went up to almost 50%. Now it's at a flat rate of 35%. Big important change there. Number two important change is that they unified the gift tax system and the estate tax system. So the gift tax system deals with your during your lifetime, giving assets away during your lifetime. And so at this point in time, they finally unified it where now we have a $5,120,000 gift exemption as well as a $5,120,000 estate exemption. Understanding the intricacies of that is dedicated to another video that we have, but it's something that you should know about. Number three important point that the legislation did was it introduced this concept of portability. And so to understand portability, you have to understand the way that the coupons worked previously. And this is where we go to our chalkboard. I think it's really important from an estate planning perspective that our clients understands how their plans work, and sometimes lawyers are the best explaining it through some of the fancy legalese, and I find that just showing it visually you get a lot more bang for your buck on it. So let me show you how it would work. So in our IRS supermarket story, when I'm checking out at the checkout counter, I'm using my coupon. And under the old law, the way that you would use your coupon is through a trust. That was the only way that you previously could use your coupon, is through a trust. Attorneys would call it a B trust, bypass trust, credit shelter trust. Attorneys are great at naming things the same differently to confuse people. In our firm, we like to use the term family trust or coupon trust. So, when a client passes away, what happens is we have this formula that we use to minimize the estate tax. And what that formula says, essentially, is that we want the first $5,120,000 of our assets, whatever the coupon amount is at that time, to go into this family trust or this coupon trust. And if you knew nothing other than the name, the family trust, who would you think the beneficiaries of the family trust would be? Maybe you guessed it. The family? Yes. And so you could say you have your spouse as the beneficiary of it, your kids, grandkids. You could even have your college roommate. Surprisingly, the IRS is liberal on how you define family. It's however you want, but it's basically you can leave $5,120,000 to any non-spouse without incurring a tax under the current laws. So knowing what we know about the history of the federal estate tax, we know that this is going to be the variable. So if Congress does nothing by the end of this year, that $5,120,000 will go down to $1 million. So maybe under current laws, your estate might not be subject to tax, but if this coupon was down to $1 million and you had more than $1 million worth of assets, including life insurance owned in your own name, then you may want to look at some planning strategies. Could change, and very likely may change in the future. It's really important that you keep your estate plan up to date. But this concept of portability, what Congress said basically was that you don't necessarily need to create a trust anymore to preserve that $5,120,000 coupon. It's not a use it or lose it type of proposition. However, you do have to fill out what's called a 706 estate tax return. And so you have to figure out what you want to do on that end. There's a lot of planning options. And if your estate is somewhere in the range where you may be subject to estate tax, whether under the current law, so it could be $1 million, $5 million, it depends on what the laws are at that time, then you are well advised to see an attorney to discuss those issues. Now, these are just talking about federal estate tax issues. In certain states, there is a state estate tax. For example, in Maryland, there is a state estate tax on any asset over $1 million. So, Maryland, if you own assets more than $1 million, you could be, or your estate could be subject potentially to estate taxes, and you'd be well served to talk to an attorney to discuss some of your planning options. This has been an overview of the federal estate tax system with Bobby Fazy, President of InSight Law. Thank you.